Welcome to the Personal Finance Signals Atlas, where we map the hidden forces behind long-term financial outcomes. In this explainer, we're going to dig into the single biggest mistake that people make when they think about financial danger.
Okay, so let's just start with a really simple truth about human nature. It tells you almost everything you need to know about how we see danger. We are wired to react to the shaking ground, right? The tremor. It's immediate, it's noisy, it's visible. But the real danger, well, that was never the tremor. It's the silent, invisible fault line underneath that caused the whole thing.
And that right there, that's the core signal we're talking about today. We consistently, almost automatically, mistake the noisy, visible events for the real sources of financial danger. We're just paying attention to the wrong things, and that leaves us incredibly vulnerable.
So let's break this down. On one hand, you have volatility. That's the noise. It's the daily market swings, the loud headlines, the visible motion. It's emotionally grabbing. But on the other side, you have fragility, and that's the real danger. It's the invisible structure, the silent weakness in your financial setup, the hidden potential for a total and complete collapse.
See, here's the kicker. Our brains are literally programmed this way. We react to the observable threat, the market dropping 2% today, because it causes immediate emotional pain. And that focus leaves us completely exposed to the much, much larger, invisible threat, the one that can cause permanent, irreversible harm.
So how does this actually show up in the real world? This isn't just some abstract theory. This pattern, this blind spot, it appears in the choices that millions of people make every single day, especially really high performers.
Think about it. You see professionals obsessing over tiny little fluctuations in their investment portfolio day to day. But the far, far greater risk, the fact that 100% of their cash flow comes from a single job, from one employer, that just goes completely unaddressed. That's the real exposure.
Or take this one. We optimize for what feels like safety in the short term, a stable, guaranteed salary. That feels incredibly secure right now, doesn't it? But what we're often doing is building long-term rigidity. We're trading away our adaptability, our options, for when not if change eventually comes, and that creates a massive hidden risk.
And all of this, it points to this deep, fundamental error in how we even think about the game. We say our goal is to maximize our gains, to maximize returns. But the true, unspoken objective, it should always be about minimizing the probability of ruin. It's simply about ensuring you get to stay in the game. So why? Why do we do this so consistently? Well, the mechanism here isn't a lack of intelligence. It's not about being smart or dumb. It's a feature, or maybe you could call it a bug, in our own cognitive wiring.
It all starts with something called loss aversion. Our brains are hardwired to feel the sting of a small, immediate loss, like seeing your portfolio dip for a day, way more intensely. In fact, it's about twice as powerful as the joy you'd feel from an equivalent gain. And this just makes us hyper-focused on all that daily noise.
And then other biases just pile on top of the problem. The availability heuristic, that means we fixate on that scary market crash we just saw in the news. Salience bias means the loudest, flashiest risks get all of our attention. The end result? We're pushed to seek immediate emotional relief instead of building actual long-term resilience.
So what's the real-world cost of getting this wrong? Well, this fundamental misunderstanding of risk has a massive cost. And paradoxically, it often hits hardest for those people who appear to be the most successful on the surface.
Let's just consider a high-income professional, right? Someone earning a salary like this. On paper, this number looks like the very definition of financial security. It feels incredibly safe. But here's the hidden fragility. If that entire income is tied to a single job in a single industry that might be volatile, well, its structural fragility is absolute. A layoff, an industry shift, a health issue, and that very impressive number can go to zero overnight.
And it gets even worse when you couple that high income with high inflexible costs. A big mortgage, car payments, private school tuition, suddenly the entire system becomes incredibly brittle. It's perfectly optimized for the best-case scenario, which means even a temporary shock to that single income stream can trigger a catastrophic cascade of problems.
Okay, so if that's the mistake, what's the alternative? How do financially resilient people think differently? Well, the secret isn't that they have better predictions about the future. It's that they have a fundamentally better framework for dealing with an uncertain one. They completely shift the questions they ask. So instead of asking, how can I maximize my gains, they're asking, how can I guarantee I get to keep playing the game? They stop looking for certainty and they start building optionality, which is just the ability to adapt to whatever happens next. And this, right here,
is the key takeaway. Wealth systems that actually last, they do so by minimizing the possibility of an irreversible loss, not by maximizing their average gain. The ultimate goal is simply continuity, to endure, to stay in the game.
And that brings us to the end. Now remember, this is not financial advice. This is a lens for perspective. So we're going to leave you with 3 questions to hold up as a kind of mirror to your own situation.
First off, what actually occupies your financial attention? Are you worried about the day-to-day noise of the market, or are you thinking about the potential for that deep structural danger we talked about?
Second, force yourself to look into your own blind spots. What silent, fragile risks are you just ignoring right now simply because they aren't making headlines? What's the fault line you're not seeing?
And finally, the most important question of all. What single event, what single point of failure could take you out of the game for good? Because whatever your answer is to that question, that is the risk that truly matters.